In this video, I'm going to tell you exactly how many shares of popular UK stocks that you would need to achieve £100 a month in monthly passive income using dividends. And if you find this video helpful, please drop me one of these to support the channel. The idea of having income that you don't have to work for that passively pays off some of your bills is a goal that many financially savvy people strive to achieve. Imagine not having to pay for some of your regular bills, an example being a phone contract. Having that completely provided by your investments would be such a quality of life increase. Furthermore, imagine if your mortgage payments were covered by your dividend income, and that's a stage where I feel that your wealth will really start to build. So naturally, one of the best ways in terms of accessibility in order to build that monthly dividend income or monthly passive income is using the stock market. So today I've selected 4 different UK stocks based on their yields, going into the high yield, average yield and low yield. Starting the list of UK stocks, we have our very high dividend yield payer called BP. They are a very popular income investment for UK investors, and that's because they have a high yield of 6.95%. Then we have a biopharmaceutical company under the name of GSK or GlaxoSmithKline, and they are currently yielding 5.43%. We also have a consumer goods company under the name of Unilever that is currently yielding our average yield of 3.13%, which I think best accurately represents our UK markets, seeing as the FTSE 100 currently yields around 3.25% according to dividend data, and the FTSE 250 is about 8% lower. And lastly, we have our lowest dividend yield payer, which is London Stock Exchange Group, with a whopping dividend yield of 0.83%. So how many shares of each of these stocks would you have to have in order to get that £100 a month of passive dividend income? It's worth disclaiming that there's not many monthly dividend stocks in the UK, and even quarterly stocks are quite rare. This means that unfortunately you will likely have to divide your dividend payments and budget it out consistently. There's no surefire way that you will get exactly £100 a month, but rather you may receive 4 payments of £300, which you would have to divide by 3 to therefore get a monthly income of £100. But what I can say is that you will, over the course of a 12-month period, providing the dividend is not cut, which I very likely doubt if you have a good quality business, that you will be receiving £1,200 in annual dividend income, which could be divided by the number of months, 12, to therefore get your £100 a month income. Although furthermore, it is worth mentioning that also, whilst there are quarterly payers such as GSK, their payments are not always equal, and whilst 3 of their quarterly payments are all 19 pence each, their 4th quarterly payment is actually 23 pence. This means that during the year you're going to have ever so slightly different payments. Perhaps in the last quarter you might receive £330, but in the other quarters you might receive around the ballpark of £290. When we look at the exact amount of shares required using these popular UK stocks, we can see that the graph is very skewed, and that is by fault of BP, but only because I'm not good enough with Google Sheets. Regardless, you would need 7,519 shares of BP in order to achieve that £100 a month. But if we compare this to something like Unilever, that only requires 815 shares. Although this data is very much pointless without the total cost of the investment, and furthermore the share prices of the individual stocks, as there is a very significant gap between the share price of BP being around £2.30 per share and Unilever being around £45 per share. Annoyingly, it's also worth noting that whilst BP and GSK are UK listed equities, they don't pay their dividends in pence, but rather GSK pays in euro cents and BP pays in dollars. This is quite annoying as it means that your income is subject to exchange rates, and the Bank of England have mentioned that at least for the pound exchange rate, they do not care for that, and rather their primary focus on the value of the pound is keeping inflation low. So therefore, over the longer term, the pound could end up decreasing against those more staple currencies that you see every day like euros and dollars. Regardless, as of this video, I can tell you that you would be getting £100 a month after the conversion, completely assuming that the exchange rates do not change, But as of this video, it would mean that you would need £17,289 invested into BP stock in order to get that £100 a month of dividend income. GSK isn't too far behind, requiring £21,423 for that same goal, but after that it starts to ramp up quite dramatically. Unilever with that 3.13% yield would actually require over £38,000 just to achieve £100 a month in dividend income. But once we go to our lowest yielding stock, which is London Stock Exchange Group, you would require over £144,000 just for £100 a month in dividend income. So, end of video, cheapest stock is BP, therefore it is the best option, and you can click off the video and go buy BP stock. Well, actually, this is not the case, and in fact, I think BP is probably the worst choice you could make. I'm not going to go into the specifics of why I don't like BP, but if you are interested in why I don't like BP or Shell, I will put a card at the top right of the video for you. Regardless, if we look deeper into it, there are a few problems, and I'm going to explain exactly why right now. Firstly, I think it's worth noting that typically the higher the yield of the dividend, the more riskier the investment is. This is because high yield dividend stocks are unsustainable. An example could be that the dividend yield has purely increased due to a falling share price, which means investors are likely selling for a reason. This only adds to the risk. Furthermore, the company could be increasing the price of their dividend and paying out more to therefore lure investors in which at that point they could dilute their share pool and kind of make money from having the share price artificially higher before they raise capital. The point I'm trying to make is that if a high yield dividend was truly sustainable and this company was able to afford it and consistently grow it, then this would no longer be a high yield, as many people in the market would then start to purchase this stock, and therefore the yield would start to lower as people are more willing to pay less of the earnings in the stock. And after all, if it was a truly great business, then the share price is likely going to increase, decreasing the value of the dividend. Obviously, with the power of hindsight, we can in fact see that BP hadn't really grown their dividend that much, and in the pandemic crash and oil price war crisis, they had actually cut their dividend. Secondly, another important factor in dividend investing is the rate of their dividend growth. If they don't grow their dividend, you're effectively losing your income to inflation. Typically, the Bank of England sets a target of inflation which is 2%. This means that whilst £100 right now could get you a good amount of spending power, next year you would need £102 for that exact amount of spending power. Effectively meaning that if these stocks aren't growing their dividend, that over time you will be losing money to inflation and therefore have less spending power from it. So typically it is a good idea to see a dividend growing. In regards to BP, they actually hadn't really grown their dividend during this time period, and furthermore obviously they had cut their dividend, which obviously impacts the amount of shareholder value. Lastly, whilst dividend stocks are a big factor in my own investment strategy, they certainly aren't the only thing that should be accounted for, and that's because the share price of stocks change from day to day, and what you do want to do is when you invest in a stock, you don't want to have your capital just rapidly decrease, but rather you not only want to preserve your capital, but grow it. And therefore, whilst BP would have looked like a great investment based on the yield, if we look at the returns in the last 5 years with dividends reinvested, that's minus 12%. You're effectively losing more money and you're drawing from that dividend income, so in fact you're even losing more money. And over the longer term, this wouldn't have been sustainable, as eventually your capital would get smaller and smaller and smaller. Maybe there would have been more dividend cuts, for example, and you would have even less money to withdraw from if you're in retirement needing that £100 a month. If we compare this to 41% with dividends reinvested in a 5-year time period with GSK, over 100% with Unilever, or even above 264% with London Stock Exchange Group. Just to clarify, I'm not saying to buy the lowest yielding stock in order to get the best returns in the stock market, but there's certainly some identifiable trends which would help us in selecting the next best dividend stock to acquire. And I think that these trends will therefore help you identify higher quality dividend stocks which are likely to outperform the market and generate a better return on investment. I'm going to tell you the trends that I've spotted so that you can perhaps add these higher quality dividend stocks to your portfolio and likely beat the market. And if you're interested in signing up to Trading 212, use my link in the description down below to get a free share worth up to £100 when you deposit £1. So if you're looking to get started with investing, sign up to Trading 212 using that link in the description down below. When comparing these stocks, I have noticed quite a significant trend in dividend growth. In the last 5 years, if we look at the CAGR, which is a compound annual growth rate, effectively meaning how much their dividend is grown or reduced over each year over a 5-year period. If we look at BP, in fact, it's actually negative. This is because they had recently cut their dividend, and obviously they are our worst performer. Then if we look at GSK, they've not grown their dividend in the last 5 years, hence why they were our third in ranking in total investment performance. Then if we look at Unilever, which are a good dividend reliable payer but aren't growing it that much, roughly around 6% in the last 5 years, but they still generated an impressive return on your investment over that 5-year period. But then if we look at London Stock Exchange Group, they had been growing their dividend over the last 5 years by roughly 25% each year. We can clearly see that there's some form of a trend here that typically means that the higher a company is able to grow their dividend, the better the quality of the dividend stock, and therefore likely the higher the shareholder returns towards you. And this is backed up by revenue and earnings trends. If we look at all of these companies, or at least if we compare BP to London Stock Exchange Group, both of our extreme opposites, we can see that BP is quite cyclical, and therefore their revenue is much like a roller coaster. At one point it's high, then it's low, based on the price of commodity of oil. But if we look at London Stock Exchange Group, they've organically managed to grow their revenue year on year. And whilst their earnings are flattening, this is likely due to one-off losses during the crisis. Basically, what I'm trying to say here is that I believe another trend is that if a company is able to consistently grow their revenue, then this is a positive outlook for the stock and likely will help you identify the better stocks to purchase. So we can see that whilst it would be the cheapest to buy that 7,519 shares of BP and therefore have that £100 a month of dividend income, it wouldn't necessarily be the best decision. And this is because you would actually have lost money during that time period, even with the dividends accounted for. And therefore it makes it a much lesser option when compared to the other free stocks that I had spoken of. Although on the other side of the scale, investing in the London Stock Exchange Group purely for dividend income, that would require a capital of over £144,000, and at that point you really likely don't need £100 a month in passive dividend income. So I think there is a balance to be found in between it. If you're investing in London Stock Exchange Group, then it's likely more of a growth investment, or you have a very long-term investment horizon in which you can allow for this dividend growth to compound and benefit your portfolio. So therefore, I feel that the best way of balancing this would be looking at a stock like GSK. They've had very positive revenue and earnings growth, although they were reversing a declining earnings trend in 2016. But rather, whilst they haven't grown their dividend in the last 5 years, if they were to change this, then this would look positive. I suspect the share price would appreciate more than it had, and you would have gotten better returns. But you're also getting a high enough yield that you can get that consistent £100 a month in dividend income. And I think they give the best balance between the cost of getting this passive income, but also preserving your capital and growing upon it. If you're interested in how much I made in 6 months of investing in the stock market, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.